Gamble and Unilever. Students have been working for the past 6 weeks to try to build these research reports. It's incredible the amount of time that they've spent not only learning how to value a company, but learning how to construct a research report. It's also amazing that the students have faced tremendous feedback and critiques that myself and the Valuation Masterclass Bootcamp team have provided them. And they have been continually improving their presentations until tonight. What we're going to see is Procter & Gamble and Unilever. And I want to ask you, what do you think? Do you have a question? Do you agree with these recommendations? Do you disagree with these recommendations? Would you buy these stocks? Would you sell these stocks? This is a great time to learn more. So I'm going to invite in our first student to get ready to do the presentation. So let me do that. First student, Roy Pim, how are you?
I'm very good. Thank you, Andrew. How are you doing?
I'm wonderful. And what time is it there right now?
Well, it's 6 a.m. in the morning in the US right now.
That's dedication.
Yeah.
And how do you feel? Are you nervous or are you excited or how do you feel?
Excited. It's my first live broadcasting, but I have a great feeling that it's going to go great.
Yeah, I think it's going to be wonderful. So what I'm going to do now is I'm going to share your screen of your report. And when I do, take it away and start talking about and walk us through your analysis. Meanwhile, for the listeners out there and the viewers out there, if you have questions while you're watching this, please type them in the chat because we'll use those questions to ask Roy Pim to get clarification. In addition, if you're watching this long after this video was recorded, feel free to still put in comments in the chat and we'll do our best to answer them. So let me start by bringing up Roy Pim's report onto the screen. And then I'm going to take myself out. And when I do, Roy Pim, you just take it away. You ready? Okay, here we go.
Thank you, Andrew. And thank you, everyone, for joining my P&G Valuation Live presentation today. So let's get started. So due to P&G shortness of growth and revenue normalization post-COVID, I initiated P&G with a sale recommendation base of $129 US, downside of 22%. I derive my target price from a discounted cash flow based valuation using a WACC of 8.3% and a terminal growth rate of 2%. So let me tell you a little bit of my story. So the first one, P&G is back to slow growth post-COVID and will get no boost from China. Second, competitive forces will keep even this mighty company revenue growth at 3%. Third, productivity and costing effort will only allow it to keep net profit margin stable, unfortunately. And as you can see, the valuation table, the PE multiple is traded at we're gonna look a little bit about P&G background and what it do. Procter & Gamble is an American multinational consumer good corporation. Its products focus on a daily cleaning, health, and hygiene needs. P&G is positioning it in a highly competitive market. With its 10 category portfolio, 50% of P&G revenue are in North America. The fabric and home care segment is a core segment and account for over 1/3 of its total sales. P&G has an excellent profitability, yet stagnant sales growth. First one is P&G is back to slow growth post-COVID and will get no boost from China. PG has reduced organic sales growth to 4%, while net sales growth is 2 to 3% in 2024 for the whole year. It is also expected that P&G largest international market, Greater China domestic consumer demand for P&G product would remain low for at least next 6 months. So the IMF, the International Monetary Fund project for China economy, is a slow of 5% in 2025, and is expected to decelerate to 3% by 2029. Hold on a second. Yeah. Due to aging and slow productivity growth. So hence, I expect a net zero sale impact from Greater China over the next few years. The second is competitive forces will keep even this mighty company revenue growth at 3%. So P&G has a competitive advantage in the laundry and detergent market, with model intelligence expected to grow by 4%, driven by an increase in household expenditure. P&G is expanding in this segment with a new Tide and Downy Pro commercial line. However, a recent Panmure Institute's Five Forces analysis showed that the company faces very high rivalry and a moderate threat of new entry. It will be hard for this product segment to perform to push the revenue growth over the next 3 to 5 years. So productivity and cost saving efforts will only allow it to keep net profit margins stable. So P&G is introduced its supply chain, which is enabling it to improve capacity and implement automated manufacturing production and use digital supply chain effectively. As a result, the company projected to reduce cost of goods sold by $2 billion in fiscal year 24. This helped gross margin increase to 52% versus 47% in the prior period. The CFO also expected continuous saving of $2 billion in COGS annually in the coming year. I expect P&G world-class expense control to allow earnings per share growth to remain in line with my expected 5-year 3% revenue growth. So now let's dive into the industry where P&G is operate. So it's a top competition in a fragmented consumer staple industry. And let me tell you why. So the consumer behavior changed to buy cheaper product during economic uncertainty. The IMF project global economic growth to slow to 3% in 2024 to 25. Though inflation has eased in 2024, fallen. Seeking Alpha stated that the consumer are now more aware of their spending post COVID-19, shifting to buy more from store branded product rather than expensive brand. According to Deloitte, this condition would suggest the consumer staple would experience slow growth. Part of Five Forces analysis show fierce competition in this market. Based part on a recent Panmure business, the consumer staple industry had a strong competitive rivalry, partially due to low switching costs. It also had a moderate threat of new entry and bargaining power of customer. The bargaining power of supplier is weak due to multiple suppliers. Lastly, the threat of substitution is also moderate due to availability of products. Third, limitation in raising products prices and supply chain disruption. Deloitte suggests that company must shift from price focused strategy to a combination of price, volume, products mix to drive further profitable growth since consumer receive further price hikes, unlike in addition to the Ukraine war conflicts as well. So next, you can see that we will talk the company financial performance for the past recent quarter. Here we can see rise in net profit margin of 1.7% increase year over year on the last slide. And in fiscal year 4 in the third quarter, PG experienced a slight revenue increase of just 0.6% year over year. A company also saw around a 9% increase in SG&A and slight increase in EBIT margin as well. So this slide, we see the consensus estimate. So overall, over 50 hold positive on P&G and issue and issue by recommendation. Yeah, I'm sorry about that. And mean target price indicate a potential 4% buy. It's a buy, yeah. The consensus show a buy and a strong buy. Deeper to P&G revenue structure. G revenue come from around 180 countries, of which are more than 50% generated outside the US, with Greater China as its largest international market by country. The top 10 customers accounted for 40% of total net sales in 2023, with Walmart and its affiliate represent about 15%. It has 5 operating segments. Fabric and home care are the core revenue contributor, contributing for about 35% for P&G. And here you can see the products and the segment that P&G get the revenue from. And now we can examine P&G investment attractiveness by using the FVMR framework, which consider fundamental, valuation, momentum, and risk, or we call as those 4 elements. Through it, overall P&G appear moderately attractive relative to over 1,000 non-financial companies in the US market. Fundamental rank in the top 40 in the US. Valuation through this method neutral and trade at both higher PB and PE relative. Momentum is on average side. So for risk, even though risk rank at top 30% due to risk measure in terms of beta to the US. So because of low risk nature or low beta of the company compared to the US market, really skewed to be relative stock. So another methodology that this is WCB, a world-class benchmarking by Astor's investment research. So by looking at these competing forces between profitability and growth, using this method to evaluate P&G internal strength, as you can see, profitable growth consistently ranked in the top 20% among over five large consumer stable company. And this is derived from, first, we look on the left-hand side, the asset efficiency has ranked number 9, and it doesn't look good, but it's moderate drag on EPS growth. However, because of the robust expense control, the poor asset efficiency, revenue growth had ranked below average as well. So let's switch to P&G forecast profit and loss statements. So the revenue increased 5% from 21 to 22, even though I have it as the absolute dollar, but that was its come down percentage, but decreased by 2% from 2022 to 3. So it shows a sign of deceleration of growth. So I expect it slow growth to average 3% for the next 5. So let's look at the balance sheets on the asset side. We can see our item grow as I expect PG to continue grow in the future, however, with a slower growth rate. Goodwill will also continue to grow as the company expect to make more acquisitions. So looking at the liability and equity side, long-term debt increased slightly. P&G has sufficient cash and had commercial paper program for its short-term debt need to support the company. So the cash flow statement show that CapEx grow slightly over proportionate to the expected revenue growth. Management also give forward guidance on limited capital expenditure in the future. So as we can see from the ratio, a negative cash conversion cycle, it shows that PG suppliers are financing its operation. And if you can see the EBIT margin that I highlighted, I forecast the EBIT margin to be 100 basis point lower than the consensus for the next 3 years. We continue with the ratio. I expect the P&G would have a revenue normalization post COVID-19, and net profit margin would remain in the range of 18 to 19% in the next 3 years. So we look at the free cash flow data. So change in the change in the working capital. So when change in the working capital is negative, the company invests heavily in its current asset or drastically reduces its current liability. So for P&G case, it reduced current liability to offset its balance in the prior year. So I expect that free cash flow to the firm to drop in 24. So now we are in the section excited about valuations. And first, let's look at the relative valuation first. So on the forward 24 PB multiple, PG is the most expensive of the four benchmarks. So I forecast its return on equity to be around 30% in 2024. Higher than the sector average, but based on the 2024 E multiple, this result in P&G trading as a premium, as you can see. And second, so the PEG ratio is traded as a relatively premium as well. P&G traded in terms of PE multiple, PG trade as a premium compared to the consumer stable sector in the US. Asia exclude Japan and the world. Trust P&G look as expensive. Is earning EPS growth to be slightly better than the US and the world average in 2024. So hence P&G in 2024 PEX ratio, it traded slightly cheaper than in the US, but still more expensive compared to the rest of the three benchmark, which is Asia, include Japan and the world, and the two benchmark, And here we are at the valuation, which is discount cash flow, and we will look at the target price, from which I derive my target price from the discount, which I free rate of 4% and equilibrium of 7% for the US market. So P&G as a low beta stock, but I assume I look at it to infinity, so I use 0.75 times as a beta. So I forecast a capital structure with around 16% debt to total capital. This result in a WACC of 3%, and I use a terminal growth rate of 2%, and free cash flow to further value P&G. So in my base case scenario, I anticipate sales growth of 3% until 2028, leading to a value of $129 per share based on the free cash flow to firm methodology. This represents a 2022 downside compared to the current market size. So next, we're going to look at sensitivity. So in my sensitivity analysis, the optimistic case, I assume a 50% growth margin until 2028. So result in a target price of $139 US. Conversely, in the pessimistic case, the gross margin I assume to be 49.5%, of the of $125 US per share. And I want to bring to you attention the risk to the company. Post-COVID is a key concern. Consumer behavior changed to buy cheaper products. Since during the economic uncertainty, limitation in raising products price for P&G as the consumer good product industry emerged from COVID-19, the limitation on hiking prices poses a crucial profit growth. The third one is supply chain disruption. And the fourth one is fluctuation due to price of input material, changing in the price of raw and packaging, transportation, energy costs are greatly out of P&G control. So, and I initiate a sale recommendation. Being a mature company, P&G is lacking in future revenue growth with no boost from China, competing in a highly competitive market. Costing effort would not improve profit margin, and there's no new catalyst price momentum. The valuation, PB to ROE show that the stock now trading as a premium. Our reason to, don't you think it's time to earn a nice return elsewhere? Thank you so much.
Excellent. Excellent. We got some questions that have come in. But I'm going to start off with my first question, and that is, the share price moved from 140 to 170, according to the chart on this page.
Yeah.
And I'm just curious, like, it seems like it's just been on a pretty steady rise. What do you think what do you think the market's perception is of it? I mean, I hear your perception very clearly, and it makes sense. But what do you think the market's perception is of Procter & Gamble?
So I think it depends on each investor returns as well and the position of their portfolio management. Even though for the past 4 years, since 2019 up until this point, P&G get a lot of benefit from the pandemics, right? So people want to spend, and the stock price reacted to that. Since the stock price depends on supply and demand. However, if you can see on the red line, the price relative to S&P 500 is going down. So it's means that P&G low beta stock relative to the S&P. The markets right now, I think we are in a bull market. So there is so many stock that offer a better dividend than P&G and offer more price momentum. And you can shift to invest in there or sell it now, you can back later. Well, I think is the reason that people like it is defensive stock, and you can add this stock into that. But I wouldn't do it now. This is a time to sell. That is
okay.
My
Great.
opinion.
We've got some questions that have come in. The first one is coming from Superwan, who says P&G's revenue from China in 2023 accounts for 9% of total revenue, which is not a significant portion. Can you elaborate on the key risks factors that you believe will impact P&G's valuation related to its revenue in China?
Yeah, that's absolutely
and
fair.
Your is showing, so anytime if you want to show anything, feel free. If you don't need to show anything on the screen, that's fine too.
Okay, yeah, absolutely. So I think this comes down to the future or forward guidance. So I think lately, maybe 2 or 3 weeks ago, the CFO mentioned, and he concerned about the China regions because to have their revenue come from the China and depends on China heavily in the future as well. They also look into the past, like SK products, which is a premium brand for P&G. And right now they are like net zero from that, and management doesn't have confidence. I think again because of the lacking of the growth for P&G as a whole, they try to look into the one of the biggest, which is China, that the revenue. So that, yeah.
Okay. We've got a question from Yusuf. It says, how confident are you in your forecasted revenue growth rates for 2024 and 2025? What factors did you consider in arriving at these figures?
Oh, that absolutely great question. So I'm pretty confident with my 3%, and that's because of correct. So, and even like yesterday, the resale figure that's coming out show that we have a soft demand from consumer. So it means that we still face a headwind. The economy as a whole would not grow, and the IMF also showed that we will have the lowest global economy for the decade, that we never encountered this low before. So it's kind of like sum up for me. I look at the consumer confidence, taking into account. That's why I forecast at 3%.
Okay. For those people that are listening, feel free to ask any questions, and of course, cheer on Roy Pim. In fact, we got some people someone said, amazing presentation, keep up the great work. So that's awesome. Let's go on to the next question, and that is, what is the effect of consumer preferences? This is from Abdul Salam. Switching to private label products on future revenue. Is it a big issue?
I think so, because this consumer staple is a fragmented market. We have so many key players. However, none of the company can influence the market. So I think it depends on each company strategy, and again, come down to the price, the volume, and products mix to drive their revenue. So that's what I can say for right now.
Okay, next question from Yusuf again. What are your views about the company's cost-cutting initiatives? Could they potentially lead to operational risk or impact product quality over the long term?
Yeah, that absolutely. I think I try to reduce the cost by convince us that it's part of their strengths. However, they also said like they also gonna cut access, CapEx, that's gonna hurt the growth of the company, and that show that management doesn't have growth of the company, so that's why they cut the CapEx, I can say. Yeah.
Okay. And Shushant says, in the quarterly data, SG&A expenses were growing at around 9% year on year. What made you make SG&A expenses muted in your forecast? How are you confident that the company will not grow their R&D and other operating expenditures despite being such a mature company?
Yeah, so it's hard to forecast to perfection, but in my view, it's like usually it's SG&A hard. It's kind of like on the last item to change because it depends on their stickiness in nature. Like there's going to be a lot, the payroll and a lot of costs that sometimes it will take the whole year to plan for the company, to material and stuff. So I think for my value, it's constant.
Okay. I think we're going to stop at that point and just share a little cheer here. You've got some nice comments. Good job, Roy Pim. Amazing presentation. Amazing. Keep up the great work. Awesome.
Thank you, guys.
Yeah, that's wonderful. All right. Last questions for me is, how does it feel to graduate from the Valuation Masterclass Bootcamp?
Absolutely over the moon. I'm so happy and proud of myself.
Yeah. And how would you describe the transformation that you've been through in the boot camp?
I think this is my real transformation in a long time. I think by me deepen my finance knowledge and have a real practice to work on is I work on my personal portfolio as well. I already, make profit. This is incredible from just taking a class, and I adjust my own style of investment from analysis. So this is a real transformation for me.
And how did you find out about the Valuation Masterclass Bootcamp, and why did you decide to take it?
Yeah, actually, I'm a student of Andrew for a long time in ethics class. So I know that but this is kind of like, it's just the right time for me after the tax seasons that I was doing. So, and I want to be able to the stock in detail to understand what driven the price. That's why I joined the class.
Well, you should be very, very proud of your accomplishment. I'm proud of what you've done. Think about it. 6 weeks ago, you were like at zero and just put on the gas and start flying. And you've done a great job. So congratulations on that. I'm going to let you go now, and then we're going to bring in our next one. But fantastic.
Thank you.
Awesome. Yep. We'll talk soon. All right. Well, ladies and gentlemen, wasn't that amazing? I mean, I see all the great comments coming in. Just to uh, just to help you understand, that was Roy Pim. That was her final presentation on P&G, and she's supported by her teammates. You can see her list of teammates right there, which is pretty awesome. Ladies and gentlemen, it is now time for our next presentation. And who is that going to be? That is going to be, hold on, let me just pull it up. There she is, Shital, who's going to be presenting on Unilever. And I know she's also been doing a huge amount of work to get ready for that. So I'm going to call her up in a second, and let's welcome her into the group. So here she is. How are you? All right. Your voice is not coming across. I think I've muted you. There we go. Okay.
Yeah.
There we go. So how are you feeling?
Very excited, to be
Wasn't
honest.
that amazing, Roy Pim's,
Yeah, actually
presentation?
it was.
Yeah. And I think yours is going to be similar, because I know you've worked your butt off to get to this point.
Right.
So why waste any time? Let's get straight into it. Now, you want to share your presentation and get it into presentation mode. And then after that, I'm going to share your screen. Here we go. All right. I'm going to pull that up on the screen. And what I'm going to do is I am going to take myself out in just a second. So maybe just go down one slide and up just to make sure. Perfect. So you've got about 10, 15 minutes, or as long as it takes. Take your time. And just so you know, when we get Q&A, it seems like we're getting a lot of questions. So keep your answers short, right? All right. I'm going to take myself out of this, and now you take it away and demonstrate your skills.
Sure. Okay, I hope I'm audible and clear to everyone. I welcome everyone in this live presentation on my valuation report on Unilever. And before I begin, I would like to first thank VMC team and Andrew for the support and the guidance throughout this process. So let's get started. In this report, I initiate a sell recommendation on Unilever, and based on a target price of 42 euros. This is potentially a downside of 16%. And I've taken free cash flow for equity as the base of valuation, the relevant cash flows. And to discount the cash flows, I've taken a cost of equity of 8.1%. And checking a terminal growth rate of 1% seems fair because the Unilever is a fairly stable and mature company. And if we have a quick look at the valuation table, the valuation multiple, which is the PE ratio, it appears to be fairly, stable for the past few years within the range of 18 to 20. And so the trend has been projected for the forecast period as well. And Unilever has a fairly stable DPS and dividend yield percentage, but the EPS growth has been quite volatile for Unilever, and sometimes it's negative as well. So let's proceed into the presentation. And before I talk about the valuation stories, let's have a brief background of the company. So Unilever is an old company. It was founded in 1860. It has its headquarters in London. And the company has around 400 brands and a market capitalization of 125 billion euros, which is quite big. It's among the top companies, and it ranks somewhere around 6th place of the top companies in the FMCG industry. This is a multinational and global company, has its presence in Asia, Pacific, Africa, America, Europe. And the company has more than 4.4 million retail stores across 190 countries. um, Unilever Group was listed as the sixth largest FMCG company worldwide in terms of its sales, and that's according to the data by Statista. Talking about the business groups that the company have, so the Unilever has total five different diversified business groups. These are personal care, home care, beauty, well-being, nutrition, and ice cream. And we'll talk about these business in detail when we'll talk about the revenue segregation of the company. But let's begin with the stories that drives the valuation. I'm focusing on the revenue segmentation over here. So the company's sales, 58% of the total sales of the company comes from the emerging market. And IMF expects GDP growth in these emerging market to be around 4%. And the rest of the sales come from the developed and advanced economy. And these are expected to grow at less than 0.5%. That's again according to the IMF report. So what I'm expecting is that the low revenue growth from the developed market is expected to offset the revenue growth from emerging market, which is not a positive sign. So this was from the geographic point of view. And if we focus on the business segment, company has 5 diversified business group. 4 of them are seem to be profitable, and one business, which is ice cream business, is not that profitable and has low growth. So it has an impact on the total revenue of the company by bringing down the average of the revenue growth of the company. And so, on the basis of this, based on the geographic segmentation of the revenue as well as the business groups, I'm expecting a revenue growth of 2% for the financial year 24. And at an average rate of, I'm expecting that the revenue will grow at an average rate of 2.3 till financial year 26 in the forecast period. Um, Coming to the past few years, there is a clear trend that the company is trying to distribute the profit in form of dividend and buyback offer, and this is particularly due to the reason that the company has limited growth opportunity. And this is due to increasing cost, persistent inflation, and increased competition not only from the private labels, which are the alternatives option available to the consumer, but also there is a strong competition among the industry players. And to state the fact, the company has returned 5.9 billion euros to shareholder in 2023 through dividends and share buybacks. And company has announced another buyback program of 1.5 billion euros in 2024. So in the absence of profitable growth opportunities, the investors are better off with these moves. So there's nothing wrong in that. Someone who wants to invest in a company for dividend, it's a good option. So the and right now what looks like is that the company is focusing on the tighter cost control, and they're shifting focus from gross saving to net productivity. And if this happens successfully, then we can expect the gross profit margin to grow from 42% in 2023 to 44% of 2026. I know this is a conservative estimate, but depending on the fundamentals and the future outlooks, this seems a reasonable forecast. Coming now to the impact of inflation. So Unilever has experienced a double-digit decline in the European volume due to high cost and competition, especially coming from the private label. America, which is a big market for the company and generates 36% of the total revenue for the company. But in this region, the revenue growth has been slow and majorly because of the price inflation. US inflation has increased steadily from 3% in June 2023 to 3.4% as of May 2024. And if you look at the prediction by Statista, the US inflation is likely to decrease to its pre-COVID level of 2.1% only by 2028, which is a quite long time. Hence, I expect a low and slow volume growth, resulting in an average of 2.6% revenue growth in the upcoming 5 years. Talking about the industry, consumer staple industry in general, um, there has been persistent problem related to supply chain disruption resulting from the geopolitical tension, which caused the shortage of raw material, higher input prices, transportation delays. And if we look at the breakdown of how the revenue has been growing, industry's recent revenue growth has been the result of higher prices while the volume was declining. So as we can see on the top right panel graph, the volume growth has been very less for all these top players, and the price growth was the major reason driving the revenue growth of this company. This is not a good indication because it's not sustainable. You cannot just keep on increasing your revenue on the basis of the prices. So we are expecting the companies will be under pressure to return to profitable volume-led growth model. And there has been evidences that many companies have struggled to deliver to the shareholder. So if the ongoing political tension continues, we can also expect supply chain disruption to persist in the future and forecast period as well, which is the first another reason why I've taken a conservative estimate on the revenue growth. A very important thing that we need to discuss over here is the shift in the consumer preferences. So, consumer goods sector reflected a shift towards the value consciousness. Consumers are increasingly seeking affordable alternative, including private label option. And inflation has pressured these companies for the past 2 years, with some brand name company losing market share to private label alternatives. And so we can expect a tough competition amongst the industry player to gain the market share. So if you look at the Porter 5 Force model, two factors are very dominant over here. Number one is the rivalry among the industry players, and second one is the competition from the substitute product because of the low switching cost. Lastly, we are coming to the outlook for financial year 2024. So we can expect that financial year 2024 will be about prioritizing the volume growth to improve the profit margin. And we can expect that the company will be doing so by making larger investment in product innovation and increasing the breadth of their product offering. We can also expect the company might increase their expenditure on advertisement and promotional offer to remain relevant and competitive in the market. Companies may also strategically pursue merger and acquisition to eliminate competition and prioritize expansion. But in context of Unilever, I'm not very confident that the company will be engaging in very large and significant acquisition, because that's what the plan of the company is, and that's what the CEO has discussed about. Coming to the quarterly and half-yearly result, unfortunately, company does not disclose much information about revenue and the breakdown on quarterly or half-yearly basis. But what we can see over here is that the revenue has been growing on a year-on-year basis at a rate of negative 4.2%. And this is because of the several factors that we already talked about. Coming to the consensus estimate, so majority analysts, which is 41%, they hold a neutral view on Unilever, and 35% have issued a buy recommendation. But if you look at the upside, it's only 2.2%. So it does not substantiate much the buy recommendation of these analysts. But clearly there is a skewed distribution towards the buy and hold recommendation. And if you look at the consensus forecast for revenue growth, gross margin, and net profit margin, we can see there is not much significant jump from 2024 to 2026, and they are expecting revenue to grow only gradually, and so is the case with the gross margin and net profit margin. And for the operating margin, there is no change expected at all. Now, coming to the revenue structure of the company, has been divided into two different categories. So based on the business segment and based on geographic region. So as I said earlier, the Unilever has 5 different diversified businesses: personal care, beauty, well-being, nutrition, and home care. These are the profitable businesses of the company, and they account for approximately 22% of the total revenue on individual basis. And ice cream business is the business which has the lowest growth and lowest profit, and so the company is contemplating to sell off this business division. Looking at the geographic regions, so Asia, Pacific, Africa is the largest market for the company, because 44% of the revenue of the entire group is coming from this region. Followed by this, we have the America, which includes North and Latin America. 36% of the total revenue comes from America. And then lastly, we have Europe, which accounts for 20% of the company's revenue. So in conclusion, we have US and India as the top largest market by revenue. And the company has, as I mentioned earlier, 400 brands. Among these, 30 brands which the company call as power brand. These are the most profitable brands of the company, and 75% of the revenue comes from these power brands, and the company is contemplating to increase investment in these 30 profitable brands. So it's like company is going to follow 80-20 rule. And as I mentioned earlier, 58% of the revenue come from emerging market and the remaining come from developed market. Now, coming to the FVMR frameworks, this compare the Unilever with a benchmark against 450 non-financial companies in United Kingdom. So when compared with this benchmark group, the company holds a neutral position on the basis of an overall evaluation of the company's fundamental, valuation, momentum, and risk. Talking about the fundamental of the company, the company comes under the top 40% of the companies in this benchmark because the company has very good asset turnover and return on equity. But when it comes to valuation, it appears to be expensive because of the high valuation multiples. On the basis of momentum, company again holds a neutral position because of the not so good revenue growth numbers. And in terms of risk, the balance sheet risk is high due to the high net debt to equity ratio, indicating a poor long-term solvency, and a low current ratio indicates a poor liquidity and short-term solvency. Looking at the beta value, one can easily conclude that the company is a defensive stock and beta values significantly less than 1. Now, coming to the WCB framework, which compares the Unilever with 540 large consumer staples company worldwide, we can see that the company has consistently ranked in top 30% among the 540 large consumer staple companies globally until 2021. But in 2020, the rank improved from number 2 and and it fell again and stayed at number 3 in past trailing 12 months. Profitable growth comes from two sources, the profitability and the growth. In terms of profitability, company is good and it ranks among the 20%. And this is primarily coming from the strong control, expense control of the company. However, the company is still lacking on the part of asset efficiency and the way the company is utilizing their assets. In terms of growth, company is at the par, not so good, primarily because of the poor revenue growth. But if you look at the expense direction, it is still improving. So clearly, there is room for improvement, and no doubt, Unilever has strong fundamental and it's a profitable company. Coming to the profit and loss statement of the company, as I mentioned earlier, revenue has declined in the recent year, and apart from that, we have projected a stable growth in the revenue at a rate of 2% for 2024, and so is the case with cost of goods sold, and recurring APS is also growing at a stable rate. So is the case with the operating margin. Looking at the balance sheet and the asset side of it, current asset of the company is growing again at a stable rate, and so is the case with the total asset. Long-term investment are going over the forecast period, and for the goodwill, I've tried to keep it at a level of 2023 because the company does not plan to do much significant acquisitions. Coming to the liability and equity side, book value per share of the company is steadily growing, and long-term debt of the company is expected to decline in the forecast period. And coming to the cash flow statement, the cash of the company is growing steadily for the forecast as well as for the actual period, and the net income of the company is forecasted to grow steadily, and so is the case with operating cash flows and investing cash flows. Coming to the ratios, as we discussed earlier as well, the company has very low current ratio and quick ratio. And if we look at the inventory conversion period and receivable collection period, there is not much different and volatility in these numbers. And cash conversion cycle has been negative, just like P&G, and that means the supplier financing the operation of the company. And profitability ratio has again been at a level, not much change. So it's the case with the EBIT margin. And coming to the some other ratios, growth ratios, as I've discussed again in the previous slide, that the revenue is expected to grow at a rate of 2%, and then 2.3 and 2.5, try to increase it at a very slow rate. And The company has very strong return on equity, and this is primarily because of the revenue per share of the asset, and the effective tax rate is assumed at 24%. And again, dividend payout ratio is fairly stable, just like the actual data, because the company resort to other options to distribute the profit. And coming to the free cash flow data, free cash flow is growing at a rate of around 4 to 6%. And again, this capex is expected to grow steadily, and so is the case with the net profit. So is the case with the operating profit. Now, coming to the valuation part of the company and starting with the relative valuation, on the basis of forward 2024 PB multiple, Unilever looks expensive compared to the consumer staple sector in UK, Asia, and global market. And I forecast a return on equity to be around 34% for 2024, higher than the sector average in Asia, world, and UK. This results in Unilever trading at a premium in the UK based on the 2024 PB to ROE multiple. And coming to the PE ratio, we look at the EPS growth. It has been negative, and I expect the EPS growth to be negative in 2024 as well, primarily because of the drop in net margin. The net margin grew in 2022 due to one-time exceptional proceed from the disposal of tea business for the gain of around 2.3 billion euros, which I don't expect to happen again, and that's why using 2024 expected PEG ratio to value Unilever is not meaningful. Apart from that, if you compare the PE ratio of Unilever with the three benchmark, it appears to be fairly valued in terms of overall world or global consumer staple industry, and appears to be slightly expensive when compared to the UK consumer staple industry. And now coming to the valuation and the assumption for the forecast. I have assumed the risk-free rate of 4% and market risk premium for the UK market to be 5.5%. Unilever has been a slow beta stock, so I'm assuming a beta will be reverting to 1 and taken a estimate of 0.75 for the long term, and which is the infinity forecast. And I also forecast that the capital structure will be around 22% of the debt to total capital, and this will result in a WACC of 6.9% and cost of equity of 8.1%, which I've taken for discounting the cash flows. I use a low terminal growth rate of 1% as Unilever is a mature and stable company, and I've taken free cash flow to equity to value Unilever. In my base case scenario, which is I've anticipated a sales growth of 2.6%, leading to a value of 42 euros per share based on FCFE methodology. This represents a 16% downside compared to the current market price. And in the sensitivity analysis, the optimistic case assume a gross margin of 46% until 2028, resulting in a target price of 45, which is still again below the current price of the company. And conversely, in the pessimistic case, the gross margin is assumed to be 42%, yielding a value of 40 per share, which is again below the current market price of the share. So no matter what the optimistic or pessimistic forecast is, my value has come out to be below the current price. So this is now the sensitivity analysis, and it appears that the valuation of the company is more sensitive to changes in the gross profit margin and the terminal growth rate in comparison to what I'm going to take as the sales growth and the discount rate. These are the sum of the risk which makes the valuation subjective. And the first one is the changing consumer preferences that I talked earlier as well. The Unilever business winning market share on a rolling 12-month basis was disappointing at 37%, and this poor performance reflects the share loss to private labels, especially in Europe. And the second reason is that Unilever is undergoing a significant organizational transformation and operating through 5 new business groups, which with some key changes still to be delivered. So how this is going to turn out, it depends, and which creates a kind of uncertainties around the valuation. And the supply chain disruption, as I mentioned earlier, if the geopolitical tension continues, it is going to affect the revenues of the company and causing the supply chain disruption. The last factor is related to climate change rates. Now, over here, two factors are working in the opposite direction. So, government is forcing the company to invest to deal with the climate change risk and mitigation of the climate change risk. But on the other hand, the investor groups are forcing a company to reduce their investment on such sustainable projects because it's harming the profit of the company. So Unilever has scraped some diversity pledges after investors told it to focus more on profit and less on social and environmental issues. So there is a battle going on. Coming back to our valuation and the theory, we have talked about the risk affecting the valuation and how I support my sell recommendation and why I've taken the revenue growth of 2% and how did I arrive at the value of 42. But all this is subject to the risk factor I stated earlier and the valuation stories that I talked about. Um, so yeah, with this, I would like to conclude my presentation, and now I'm open for any question.
Excellent. Unfortunately, we've run out of time. So let me ask you the question. How does
Okay,
it feel to graduate from the Valuation Masterclass Boot Camp?
very good, proud and relaxed. To be honest, all the hard work has paid off, and I've learned a lot from this entire assignment.
Well, it really shows in that presentation for sure, like the amount of time that you spent on that. How would you describe the transformation that you went through in the Valuation Masterclass Boot Camp?
Yeah, so basically thing that I learned from this assignment is that there is a lot of information available for us to read and uh, think about, but then what's important is the relevant information. How do we pick the relevant information which is going to support a theory and the valuation? So this thing I learned from this assignment, that we don't have to look at each and every information, but to the information which is relevant to me. And the next thing is, how will we be communicating this information with your investors so that you can easily understand?
Wonderful. In fact, you realize that Chat GPT is not going to kill us yet, because it's not about information. It's about how do we pull together and come up with our opinion. Can you just explain how you found out about Valuation Masterclass Bootcamp and why you decided to join?
Yeah, so I found out about Valuation Masterclass through my LinkedIn profile, and I decided to join because I wanted to apply the finance knowledge that I had and wanted to have a first-hand experience about the valuation.
Well, very proud of you as my one of my students, and I look forward to your further growth. And I think you've been a great demonstration to everybody about what you can create in just 6 weeks. So congratulations, and we will see you in the next room where we have our other presentations coming up.
Thank you.
Okay, bye. Well, that was incredible. Both presentations by Sheetal and Roy Pim were amazing. Really proud of the work that they've done. So we're going to wrap it up. Feel free to ask any questions in the chat, and we'll be sure to answer those questions. Have a great day.